Hey everybody, this is Pat Jennings from BizSeller.com, and this is the second video in our series of videos on the basics of business valuation. In our last video, we talked about using your company's earnings as the basis for your valuation instead of using some type of rule of thumb or using your gross sales figure. So the key question becomes, how do we define earnings? Is it your cash flow? Is it your gross profits? Or should you use something called EBITDA? Well, remember in our last video, we talked about how the buyer is going to buy your business for one reason, to enjoy the income and the perks and benefits that the business supplies to its owner. So we need to begin the valuation by finding out exactly how much money is available to the owner. And that amount is reflected in a number that's called the owner's benefit. Now, the formula for determining the owner's benefit is your company's annual pre-tax profits plus your salary as the owner, all of the owner's perks and benefits, which we'll talk about in a moment, your interest payments, and depreciation. This calculation will tell the buyer exactly how much money the business makes available to its owner. And since the buyer's interest payments and tax payments will be different from yours, you want to include your pre-tax profits and any of your interest payments in this number, and from there, the buyer can estimate what their own taxes and interest payments will be, and ultimately, they'll be able to determine how much money your business can generate for them if they buy it. Now, the perks and benefits can include a lot of things that you enjoy that the business pays for, but that are not necessarily reflected in your salary or in your profits. And some of the more common perks are an automobile lease. A lot of business owners will, drive a nice foreign car that's leased at $500, $600, $700 a month, and that's a great benefit. But the new owner, the buyer of your business, may not be interested in that. They may want to spend that money somewhere else. So again, that's something that you benefit from that's paid for by the business that we don't see in the profits. Travel expenses is another common one. Some owners like to go to all the trade shows and all the conventions. Other people would rather just stay at home and spend that money on something else. And a really common one is paying family members more money than they'd have to pay if they just hired somebody off the street. So if you have a teenager of yours working in your business and you're paying them $20 an hour to do a job that, the market would pay $10 an hour, well, the new owner could hire somebody to do that job for $10 an hour and pocket the other $10. So again, these are things that are great benefits to the owner, but we don't see them when we look at the tax returns or the bottom line profits. So that's a big one. All the things you want to go through and look at all the things that you enjoy, a cell phone or lunches or things that the business pays for, that's money that will be available to the next owner. So that's the key concept, is that we want to find all the money and all the benefits that the business provides for its owner that doesn't show up on the financial statements or the balance sheets. Because when someone looks at buying your business, before they can buy it, they have to determine three things. Number one, does this business generate enough income that I can pay myself a reasonable salary to live on? Because most small business buyers, they're looking to replace their regular income, their income from their job. So they have a certain lifestyle. They want to be able to live, at least early on, they want to live close to that lifestyle that they've been living and their family has been living. They need to make debt payments out of that owner's benefit number. And even if somebody pays you all cash, if you're not willing to finance the sale at all and you're looking for someone to pay cash, that's fine. But you have to realize that person is probably borrowing money from someplace. And so once they take the business over, every month they're going to have to make payments on their debt. And the third thing, and this is really what you want to look for this in a buyer. You want a buyer who wants to expand the business. They want to expand the product line or the marketing. So each month, out of the owner's benefit, they have to pay themselves a salary, they have to make payments on their debt, and they would like to see some money left over to reinvest in the business. And if somebody looks at your owner's benefit figure and can't see how they can pay for all three of these things, it's going to be hard for them to buy the business. That's why you want to start the valuation with the owner's benefit, because that's what the buyer is going to be looking at. They may not call it the owner's benefit, but when they sit down and look at your financial statements, that's really the number they're trying to figure out. That's the number they need to know in order to decide whether they can buy your business, whether they should buy your business. Now, that's just the beginning. What we want to do now with this number, the owner's benefit, that is now the definition of earnings, is we want to then go on and do a multiple of earnings calculation, or use the multiple of earnings method to develop a price range for your business, where of course the earnings is defined as owner's benefit. And that's what we're going to cover in the next video. And if you're watching this on YouTube, you can go down to the description section, and there's a link at the end of the description to that next video. So we'll see you there.